So we'll start with question number 9 now. Capital budgeting with calculation of cash flows. So usually in the previous case, we have been given the cash flows directly. In this illustration, we have not been given cash flows. Our duty is to find out the cash flows first, and then we will proceed. Find out cash flows from the following details and calculate NPV. So our intention is to find out the NPV. We have been given the cost of assets, scrap value at the end of 5th year. Working capital 1 lakh is required at the beginning of 1st year, and sales every year and cash expenses every year 80,000 rupees. Applicable tax rate and cost of capital is given here. Right. See what happens. The life of the project being 5. Initially, we spent 550,000 rupees. Nth period, we get 50,000 rupees back. So I put the values in bracket representing cash outflow. Without bracket means cash inflow. Apart from that, I am in need of 1 lakh for working capital at the beginning of 1st year. So very first year itself, I spent 100 rupees. Okay, I recovered that by the end of 5th year. Clear. We have been given the applicable tax rate and cost of capital. Let's now calculate other cash flows from the operations. Okay. Sales being 2 lakhs minus cash expenses 80,000. The value what you get here is called EBITDA, earnings before interest, tax, depreciation, amortization, or cash inflow before tax. Now I have to subtract the depreciation. So depreciation in this case being 550 is the original investment. We can get the scrap value 50,000 rupees by the end of 5th year. So 1 lakh rupees will be the depreciation to be provided year on year. So after this, the value what you get is earnings before tax. Earnings before tax. Of course, we don't have the interest component, so we can call this being EBT. From there, I have to subtract the tax component. The tax component in this case being 30%. 30%. Is that okay? In the text, I have changed this being 5 lakhs and this being 3 lakhs. So I change this. Okay. Sales 5 lakhs. Clear. Sales 5 lakhs. Cash expenses 3 lakhs. Make small correction in the values. In the text itself, we can correct. So EBITDA 2 lakhs and EBT being 1 lakh. Otherwise, NPV being negative. That's why I have made the change in the text, but not incorporated in the text. Corrected, but the edition doesn't contain that correction. So you can correct this. Applicable tax rate in this case being 30%. So 30,000 rupees should be subtracted from the EBT. Then I'll get EAT. EAT being 70. But I'm in need of cash flows only. So I have to add the depreciation, non-cash items back. Here the depreciation is 1 lakh. I have to add the depreciation back to get the cash inflow being 1,70,000 rupees. Cash inflow after tax. Or simply cash inflow. If I say it is being the cash inflow, it represents only cash inflow after tax. Cash inflow after tax. Is that clear? So every year end you are getting 170, 170, 170, 170 and 170 and so on. Right, let's now calculate the NPV here. NPV. So for the calculation of NPV, you have to find out the present value of the cash flows. Summation of present value of our discounted cash inflows. Discounted cash inflows. First one is all about this part. Cash inflow per year. Cash inflow per year. Revenue. 1,70,000 rupees. You multiply with the annuity factor at the rate of 10% for 5 years. So, annuity factor for 10% for 5 years being 3.791, and PV factor for 10% for 5th year is equal to 0.621. To make a note of it. What are the cash flows we get? Due to the operation, I get one cash flow. Due to selling the asset in the nth period, as well as realizing the working capital in the nth period, I get 150. That should also be brought to the correct value. 1,70,000 rupees is multiplied with the annuity factor because we are getting the 1,70,000 year after year. If I multiply with 3.791, the discounted value being 6,44,470. Second part is all about discounted cash inflow related to scrap value as well as working capital realization. Realization of working capital. 150 is multiplied with the PV factor. It's only applicable for a year. So 150 into 0.621. Then this value being, come on, 93,150. Then overall value being 7,37,620 minus cash outflow. So initial capital employed 550. Apart from that, we are in need of fund for working capital, another 1 lakh. So we invested 6,50,000 rupees in the very beginning. Though we invest 6,50,000 in the very beginning, over the 5 years period, we get around 7,37,620. So we get additional amount only by 87,620 in terms of current value. This is called NPV. As NPV being positive, we can recommend this one. So as already told you, how the tax plays the role on cash expenses, non-cash expenses and all, we can use that logic the other way, of course, for the extra learn. Okay, this is cash income, this is cash expenses. Depreciation is non-cash expenses. You consider what could be the tax impact on these three, you remove that and you will get the final answer directly. C, sales. Whatever the sales or income may be, cash income, into 1 minus T will be the net cash income, after tax income being into 1 minus T. So 5 lakhs into 1 minus T, T here being 0.3. Then the ultimate value being 3,50,000 rupees. It is income. In case of cash expenses, 3 lakhs into 1 minus T is the net cash expenses. 2,10,000 is the cash expenses. Am I right? 2,10,000 is the cash expenses. In case of depreciation, which is the non-cash expenses. In case of non-cash expenses, to the extent of T on that non-cash expenses becomes your income. So here the depreciation being 1 lakh on that into T 0.3, 30,000 becomes income. So this is income. This one is expenses. This one is also income. If you ask me how the depreciation comes as an expenses or income, so depreciation is not income, but tax saved on debiting the depreciation in the P&L account is your income. So ulta, you have to think in another way. So in that angle, non-cash expenses to the extent of T is considered as income. After doing these three adjustments, find out the final value. I think the final value being 1,70,000. Hope we got the same answer here. This is the traditional method that you know. If you understand the logic of tax impact on all the other items, you can get the answer directly this way also. Clear? So in the previous class, I have given the summary also. For income, any cash income to the extent of 1 minus T is your income. In case of non-cash expenses, to the extent of T becomes income. Non-cash expenses like depreciation. In case of non-cash expenses like depreciation, amortization, to the extent of T becomes income, not the expenses. The same way in case of non-cash income, to the extent of T becomes expenses. Understand? So this is the logic. I have given the format also here in detail. Okay, here it is given, the format. Using this format, I have solved the calculation of cash flow. So both the way, the traditional way, sales minus cash expenses, after that depreciation subtracted to get the EBT minus T, you get it, again add the depreciation back to get the cash inflow. That's one method. The another method is directly you can adjust the tax impact on each and every item here. In both the cases, you will get the cash inflow being the same value. Clear? Yes, come on, make a note of it. Shall I move on to the next one? Text me once it is over. Question number 10. One of the comprehensive illustration. Next question. Number is not changed. You can correct it. Okay. We can number it as 9A. Next one being 10. One of the beautiful illustration where calculation of cash flows is the most important component here. Okay. So the sum runs around one full page in the examination. See from here to here. Actually, when the sum runs through one page, you think whether it's a comprehensive, writing comprehensive, I have a question for the exams. You have to read and understand and solve the questions in a matter of 20 or 24 minutes. One 16 marks question should be solved within 24 minutes. Let's see now. Right. X Limited, an existing profit making company, is planning to existing profit making company. Currently, this company is making nice profit. To introduce a new product with a projected life of 8 years. So they want to introduce a new product, and that has a life of 8 years. It means you need to get the money for 8 years. The initial equipment cost rupees 120. So cash outflow at the 0th period for this equipment being 120 lakhs. 120 lakhs. Clear? Then additional equipment costing 10 lakhs will be needed at the beginning of third year. At the beginning of third year, right? Means second year in. I need to further invest another 10 lakhs. So I introduced two different assets for this project. 0th period I spend 120 lakhs. Second year in or third year beginning. Both are same. First year in or nothing but second year beginning. Similarly here, third year beginning is nothing but second year in. At the end of 8 years, the original equipment will have resale value of equipment equivalent to the cost of removal. So this one, we sell for any value. That value is equivalent to the replacement value. Means removal cost. If we get around 10 lakhs rupees for the removal, we have to spend 10 lakh. It means scrap value is 0. Scrap value by the end of 8th year. Cash inflow at the 8th year being 0 for this. Is that okay? We get nothing. Clear? But the additional equipment would be sold for rupees 1 lakh. But this can be sellable for 1 lakh. So two equipment we invested. One is for 120 lakhs. That too in the very beginning of the project. At the end of the project, it gives me no revenue at all in my hand. Though we get some collection, but that collection is used for removal cost, so we don't get any cash in our hand. Second machine we purchased by the end of second year end, and of course by the end of 8th year I get 1 lakh. 1 lakh. Clear? Working capital 15 lakhs will be needed. Apart from that, we are in need of working capital 15 lakhs. Cash outflow at the 0th period. In case of working capital, not necessary to tell whether it is going to be recovered or not. Nth period, it is always assumed to be recovered. Okay, 15 lakhs is recovered. So working capital required, later on it is recovered without any loss. 100% capacity of the plant is 4 lakhs. Okay, this plant has capacity to produce 4 lakhs units per annum, which is the 100% capacity, but the production and sales volume expected are as under. Okay, so what happened? Production. You produce only 20% capacity in the very beginning. So out of 4 lakhs, 20% means you can produce only 80,000 units. Second year, 30% means 120 units. This is year 1. This is year 2. From year number 3 to 5, the plant is operated at 75% capacity, means 300. And from year 6 to 8, the plant is operated at 50% capacity. Again, capacity reduced here, 200,000. Is that clear? Now let's see. I'll keep all the details here. Okay. The sale price of ₹100 per unit with a profit volume ratio 60%. Profit volume ratio means for ₹100, 60% is your contribution, which is ₹60. From the contribution, of course, you have to subtract fixed cost. Okay. If I multiply the PBR with the sale, the profit what I get is named as contribution here. From the contribution, you have to subtract fixed cost if it is given. Right. The fixed operating cash cost. This is fixed cost. You have to subtract this one, which is 16 lakhs. In addition to this, advertisement expenditure will have to be incurred as under. We need to incur this one also. Right. So from this, it is very clear. We will find out the revenue easily. What about the contribution? Contribution being 60 per unit. Multiply with the production number of units with ₹60 to find out the contribution. You can produce and sell 80,000 units in the very first year. For every unit, you get ₹60 contribution. Else, you have to multiply with 100 and you have to calculate 60% separately, but you can directly calculate 60%. Okay, 60 into 80. Okay, so 4,800 thousands or 48 lakhs. Okay, in this I have reduced to 3 zeros, isn't it? All are in thousands. Okay, next one is you have to multiply with 60, right? 120 into 60, the value being 7,200. 300 into 60, 1,800. 200 into 60, 120, 1,200,000. From the contribution, you have to subtract what? Fixed cash cost. Fixed cost, which is around 16 lakhs per annum. 16 lakhs, otherwise 1,600 thousands. Always. I think this value is 18,000, right? This will be 12,000. I stand corrected. 200 into 60. 1,600. Apart from that, we have been given the advertisement expenditure. 30 lakhs in the very first year. 30 lakhs. 30 if I cut, then it is 3,000. 1,500 thousands. 10,000 thousands. 400,000. Is that clear? Clear? Also remember, you have to subtract the depreciation. Depreciation for the first asset. It has a life of 8 years. 120 minus 0 divided by 8 under straight line method, depreciation being 15 lakhs. For the second machine, 10 minus 1, 9 lakhs divided by 6, 1.5 lakhs. Be careful, for the second asset, the depreciation will be calculated only for 6 years because it was introduced at the end of second year. So third year, fourth, fifth, sixth, seventh, eighth. So only to these years you have to calculate the depreciation. Okay. Working capital has no depreciation. So very first year we have only asset 1, second year also. Third year onwards we have 2 assets. So for the first 1 and 2 year, the depreciation being 1500,000. Third to remaining year, we have 2 assets. The 2 assets depreciation 15 plus 1.5, 16.5 will be depreciated. So from here, 1650,000, 1650,000. Now from the contribution, you have to subtract all the expenses to find out the earnings before tax. Earnings before tax. So the earnings before tax in the very first year, I think, how much? 11,000. You have to subtract these two. 4,800. From that, you have to subtract these two. 1,300. 1,300,000. 1,300 or 1,300 being the loss. Being the loss. And next one being, I think you get the gain of 2,600, then you get gain of 137,50, then 83,50. This is your earnings before tax. Now you have to subtract the tax. You have to subtract the tax. Right. Clear? Now the applicable tax rate in this case being, applicable tax rate in this case being 50%. You have to subtract the tax and then you will get EAT. But I am in need of cash flow, so you have to add the depreciation back to get the cash inflow. So you have to add the depreciation back to get the cash inflow. Clear? Now, what is the depreciation for the year 1? We had a loss of 1,300,000. Then what is the tax amount here? Okay, you can assume 0 or you can assume 650 profit. Like 3 assumptions are there. I will explain all the 3 assumptions here. All the 3 assumptions before I go for calculating the tax on the loss making company. Right. So what happens in case earnings before tax being 1,000 loss? This is year 1. And applicable tax rate being 30%. How can you calculate now? In the assumption number 1, your tax being 0, you cannot calculate. As there is a loss, you no need to calculate the tax. As well as in the second year, you made 4,000 rupees profit. First year, as there is a loss, you don't pay any tax. In the second year, you made a profit of 4,000. For that, 30%. 1,200 could be the tax amount. 2,800 will be your EAT in the next year. This is method 1. This is method 1. Loss, no tax, profit is there, then tax is applicable. In the second scenario, assume the EBT being 1,000 negative in the very first year, positive in the second year. First year you don't have tax. Second year your tax being you are now claiming the benefit of loss to be adjusted in this year. You are telling to the income tax department, so last year I made a loss. In this year I made a profit. Can I adjust the loss in this year? Of course you can do. From the 4,000 previous year loss can be adjusted. This is called set off and carry forward. Previous year loss is set off in this current year. After setting off of the previous year loss, the net gain in the second year being only 3,000. Will I be able to pay the tax only on this? Of course, you can pay the tax only on this value, which is 900 rupees. The earnings after tax in the next year being 3,100. This is the second approach. To claim the previous year loss to be adjusted in the current year's profit, you need to fulfill some of the conditions. If you might have studied income tax in your group 1 course or otherwise in your college days, you may know. To claim any loss to be set off in the subsequent year's gain, you have to file the return of income within the due date stipulated, else you cannot adjust this. We assume this fellow has furnished the return of income in due date, so he is eligible for claiming the previous year loss in this year. Third approach. Let me go for the third approach. In the third approach, year 1, year 2. Earnings before tax in the very first year being 1,000 loss. In the second year is 4,000 gain minus tax. Then you will get EAT. How? Assume that this is an existing company and also currently making the profit. Currently making profit. Profitable one. Currently making profit. Clear? Currently making profit. So XYZ company, they already have a division called A and now they have established division B. Their earnings before tax in this one, earnings before tax, okay, listen. Okay, earnings before tax. Okay. Earnings before tax in the existing unit A makes a huge profit 10,000. We came to know in the current project we lost. If he has not taken this project newly, for this 10,000 he has to pay the tax 3,000. Because he has taken this, he can set off this loss here. As he has the chance to set off the loss-making division's loss in the profit-making division's profit. Because of this reason, his total taxable income is 9,000. For that 30% he has to pay only 2,700. It means for the 3,000 he has to pay 2,700, means 3,000 rupees he saved in tax amount. In that assumption, for the 1,000 to the extent of 300 will be the tax savings. If there is any loss in any one of the year, we assume that company has some other division making huge profit. This loss can be adjusted there. Because of that adjustment, the profit of that division is decreasing. The profit of that division is, profit is decreasing. Ultimately, it reduces the tax liability. So to the extent of loss, we assume there is a tax savings. The ultimate earnings after tax being only 700. This is another assumption. And the next year for the 4,000, of course, you have to pay the tax 1,200. So balance 2,800 is the earnings after tax. So three approaches we have. One of the approaches where in the current year the company has loss. Forget about the tax. In another assumption, if there is any loss in this year, wait for the subsequent year's profit. In the subsequent year, if there is any profit, previous year loss is adjusted for the balance amount, you have to pay the tax. The third assumption, if there is any loss, we assume that company has some other division where they are making profit. So this loss can be adjusted in that profit so that any loss happens, that reduces your tax liability. It may be savings like, so 300 rupees positive value in this case is tax savings. That's how we can assume. In this illustration, I'll go with this model. You see that X Limited an existing profit making company. Then the right approach could be this one. Because already they have a profitable wing. Because of this new project, they have lost. This loss can be set off there. Because of adjusting the loss of this division to the existing division, that division's profit will go down. Ultimately, the tax payable will also be decreasing, which is a savings for us. This way you can follow. Anyhow, the method I'm going to follow for this illustration being this one. Is that clear? You can write your assumptions also in your examination. So I assume this model for this solution. Clear? Clear? Let's see here. As there is a loss, I no need to pay tax here. That's assumption here. 1300 being the ultimate value after tax. Second case 50 percentage. Of course, there is an income, so I directly calculate the tax on that at the rate of 50 percentage. Third year also 68.75. Then sixth to eighth year 41.75. So what assumption I have done here? Among the three treatment for taxation, I have assumed one of the treatments. So earnings after tax being 1300 for the second year, 68.75 for the year 3 to 5, 41.75 for the year 6 to 8. With that, you have to add the depreciation back to arrive the cash inflow. The depreciation we found out earlier being 1500 for the year 1 and year 2. From the year 3 to 8, the depreciation is 1650 because we have installed the two machines here. For the one machine 1500, another machine 150. So in total it's 1650. Depreciation is a revenue like that should be addable item to arrive the cash inflow. So from the calculations for the cash inflow in the very first year could be 200 positive for year 1, 2800 second year, third year 8,525 and third year 5,825. We got the value. So the applicable tax means the discount rate being 12% after tax cost of capital should the project be accepted. Now you can go for calculating the NPV. You can calculate the NPV. Let's see. I will calculate the NPV here. Now NPV calculation. Year 1, 2, 3, 4, 5, 6, 7, 8. 8 years are there. Find out the cash inflow. Cash inflow in the very first year being 200,000. Second year 2,800. Year 3 to 5, 85.25. 85.25. 85.25. And from 6 to 8, my cash inflow being 58.25. 58.25. 58.25 cash inflow. Apart from that, 8th year I get two more cash inflow, 100 rupees, another one is 1500. 100 rupees is nothing but sale of the additional asset, 1500 is nothing but realization of the working capital. Original fixed assets we installed very beginning has no revenue, right? Now you have to find out 12% PE factor. Come on, tell me the 12% PE factor. Take 3 digits. Take 3 digits. 0.893, 0.797, 0.712, 0.636, 0.567, 0.502, 0.507, this one, right? This one. Finally 0.452, the last one for all the three, 0.404. I can round off this for all the three. Discounted cash inflow. So you multiply these two to find out the discounted cash inflow. Very first case 178.60, second case 2231, 2231.6, third one 6069.8, fourth 5421.9, fifth 4833.8, 0.675 and 2953.275, then here 2632, 32.9. Finally, by adding up all this value, I can make it 1600 here. So you add up these two and multiply with 0.040, sorry, 0.404, 2999, 99.7. Now summation of discounted cash inflow in this case being 27321.45. From there I have to subtract cash outflow. This is cash inflow. Cash outflow should be subtracted. Cash outflow. In case of cash outflow, cash outflow at 0th period being 120 and 15 lakhs. Okay, 120, 12,000 and original asset or asset 1. Okay, cash outflow. Asset 1 value being, okay, 12,100. For working capital 15 lakhs, otherwise 1500. For asset 2 10 lakhs, otherwise 1000. But this asset 2 invested when second year end. The second year end conversion rate being 0.797. So asset 1 and working capital invested at the 0th period, but asset 2 invested second year end. So the time value of money to be adjusted to bring it to equal to 0th period value by applying the PE factor for the second year. After that, this value being 797. Then the total cash outflow in this case being 14297. Now NPV. Subtract this value from the cash inflow, you get 130.24.45. Clear? So one of the comprehensive illustrations. Now, in capital budgeting, so in investment decision, we have seen the theory and also we have studied all this model including modified IRR, modified net present value and all, discounted payback period and all. Only one method is pending. This one is available only for CMA, not for CA. So anyhow, it's a small concept. Only one illustration was there in the CMA book, so I have incorporated that one also here. We have almost completed all the appraisal techniques. Now we have to study the variations. What are the variations are going to be studied? In your practical problems, You have to first understand various capital appraisal techniques. We have completed that earlier. Step 2, you have to understand how to calculate the cash flows. We have studied some illustration for this. PAT plus depreciation minus capex. We have seen that. And we understood the drawback of IRR also in the previous classes. Now we have to complete the fourth, fifth, and sixth aspect here. Fourth, this capital appraisal technique can be used for various purposes, one of them being mutually exclusive projects. Mutually exclusive projects with a different life and the same life, we have to find out. Mutually exclusive project means we have two projects. If you choose A and you cannot choose B, or if you choose B, you cannot choose A. One of these two can be chosen. You cannot say I need to choose both. Okay. Would you like to have full meals or variety rice? No problem, sir. I will have both. Rare scenario. Huh? You can either have full meals or variety rice. It's not both. That's called mutually exclusive. Would you like to have ice cream or sweets after the meals? Give me both. That's not mutually exclusive. Our stomach is ready to accommodate for sweet and ice cream. How many of you tasted sweet and ice cream in single scoop, single bowl? Mixing the ice cream and gulab jamun. You have tasted only gulab jamun. There are a number of varieties are there. Huh? Brownie with ice cream. See. Okay, the others also got attracted for this subject. When it comes to the eating matter, then okay. You understand? So, you eat both, then it's called combined. If you consume one, another one you cannot consume, then it's called mutually exclusive. Using the capital appraisal technique, you are going to choose one of the projects. You have 4 or 5 projects. Among the 4 or 5 projects, you have to choose only one. By choosing one, you have to deselect the others. This is called mutually exclusive. In this case, both the projects will have equal life, or sometimes these projects will have different life. Clear? So you have to understand these two. Fourth one, I try to finish up this aspect first of all. Now let's move on to the question number 10. Question number 10 is all about mutually exclusive projects. Question number 11 is also mutually exclusive projects. Question number 12 also mutually exclusive projects, but their life is totally different. Project A may have a different life and project B may have different life. So these are the 3 illustrations we are going to study under the model of mutually exclusive projects. A company is faced with the problem of choosing between 2 mutually exclusive projects. Project A requires cash outlay of rupees 1 lakh and cash running expenses being 35,000. One of the beautiful illustration. Until now we have studied cash inflow, but here we don't have cash inflow, only cash outflow. If there is cash outflow and inflow, then we can use NPV model. Okay, so you have to subtract the cash outflow from discounted cash inflow, so to find out NPV. But we have only cash outflow. What can we do? Okay, if I run a cab business, rent a cab business. If I buy Innova car or normal Maruti car, which car gives me more cash inflow? You have to find out the cash inflow. The car cost, capital investment, running cost, periodical expenses. You collect the fare from the customers is your revenue. Revenue minus cost. But I'm not having the rent a car, cab. I want to purchase the car for my purpose. Definitely there is no revenue. Do I want to go for Innova car or Maruti car? In that case, I need to consider based on the lowest expenses only. We don't have the net present value. Lowest expenses model will be taken. Similarly, in this illustration, they have given you only expenses to run machine A or machine B. Now you have to find out what is the lowest cost machine to be chosen. So we have project A as well as project B. So project A as well as project B. And cash outflow at the 0th period being 1 lakh for A. Apart from that, cash outflow from year 1 to life end, being 35,000 per year. On the other hand, project B will cost 1,50,000 and requires cash running cost being 20,000 rupees per year. Both the machine have an 8-year life. So how many years it has a life? 8. Project A has a salvage value of 4,000 cash inflow, which is nothing but salvage value or scrap value. Scrap value, otherwise named as salvage value. You get 4,000 rupees by the end of 8th year, and in case of B, you get 14,000 rupees by the end of 8th year. Then applicable tax rate 50% and applicable cost of capital being 10%. Assuming depreciation on straight line basis, ascertaining which project should be accepted. Which project should be accepted. Now listen. Now listen here. We don't have what? Inflow. Only one scrap value we have here is the inflow. Others are only outflow. Let's start with the cash outflow calculation. Cash flow calculation. Running expenses. Expenses per annum or cash expenses per annum. Cash expenses per annum. For machine A, machine B, 35,000, 20,000. And depreciation also one more expenses. The difference between original value minus scrap value divided by the life 8 years. 1 lakh minus 4,000, 96,000 divided by 8. 12,000 per annum for A. For B, 1 lakh 50 minus 14,000, 1 lakh 36 divided by 12. So 12 divided by 8. What is the value? 17,000. Then ultimate expenses being 47,000. Cash flow before tax. Here that is 7,000. This is cash flow before tax, negative. Now we have to subtract the tax. Calculate the tax being 50%. Okay, whenever there is an expenses, for the expenses to the extent of tax will be subtracted. Net of that will be calculated here. 23,500. Here 18,500. Now cash flow after tax. Okay, or this is profit before tax negative. Profit before tax negative. Profit before tax. It's not profit, expenses before tax. And tax is adjusted to get the profit after tax, which is 23,500, but actually it's loss only. I can name this way also to make you understand clearly. Is that okay? You can use this way also. The negative represents negative. Tax 23,500 seems to be savings. As this being the expenses, by debiting these expenses to that extent of profit may go down. Ultimately, it results of the tax savings, right? And in this case being 18,500. In this case being 18,500. With that, you have to add the depreciation back. Come on. The depreciation for the machine A being 12,000. For B, it is 17,000. Now, come on, tell me. Tell me the cash inflow or outflow. Cash flow. Come on. What's the value? Now, listen. This is expenses. This is expenses. This is expenses. Tax is savings. Ultimately, PAT negative. If you add the depreciation back, depreciation is the revenue like. If you add then what about the cash flow? 11,500. That's why I told you it's one of the fantastic illustrations. All these things are expenses. You have to think differently. Differently. It's not income. Cash expenses and depreciation also expenses. Profit. It's not profit before tax. So loss before tax. As this being the loss before tax, to the extent of tax on that will be your savings. When there is an expenses, there is a savings. Here the tax 23,500 being your income. After that income, your net tax after net loss after tax being 23,500. Net loss, you have to add the depreciation back. Depreciation is a positive value. So 23,500 is a negative value. With that, if I add the 12,000 back, then you will get the cash flow being 11,500. What do you do here in the previous case? you add the depreciation back, where this one being your revenue, this is also revenue added, but here it is a loss, this is positive, then the ultimate value being net of that, net of that. Is that clear? You have to be double cautious here, don't make a mistake here. Clear? Now next one, 18,500, this is the loss and 17,000 is the gain, ultimate value being 1,500 cash flow. Ultimate value being 1,500 cash flow. Clear? Now, this is per annum from year 1 to year 8. Now we have to calculate the NPV. We have to calculate the NPV. Discounted cash flow for this one. You have to find out the annuity factor at the rate of 10% for 8 years. Annuity factor for 10% for 8 years. Come on, get me the value. Make it faster, make it faster. 5.335. So you have to multiply that 5.335 with cash flows to find out the discounted cash outflow. I think 61,353 negative. Here 8,003 negative. Apart from that, cash outflow at the 0th period. Discounted cash outflow over the year and cash outflow at the 0th period. This is the cash outflow at the 0th period. 1 lakh and 1 lakh 50. For A, initial cost is lesser, but running cost is higher. For B, initial cost is higher, running cost is lesser. Apart from that, cash inflow by the end of 8th year or discounted cash inflow because of selling the asset at the end, scrap value. Now find out the PV factor at the rate of 10% for 8th year. Come on. I think it is 0.467. So you have to multiply this with the PV factor to get the discounted cash inflow by selling the scraps. 4,000 into 0.467. This value being 1868. 1868. Next one, similarly 14,000 into 0.467. This value being 6538. 6538. This is revenue. These two are the outflow. This is the inflow. Then net to value. Net to value. Net outflow. Net to cash outflow. In the very first case being 1,59,485. Next one being 1,51,465. And which among these two is chosen? B is chosen, not A. As this is being the cost, lowest cost will be the best one. So we have to choose B, not the A. Not the A. Clear? XYZ Limited is considering two mutually exclusive projects. Both require an initial cash outlay of 10,000 each for machinery and have life of 5 years. So two machines, both requires 10,000 and life being 5 years. The company's required rate of return is 10% and tax rate being 40. The projects will be depreciated on straight line basis. Net cash flows before taxes expected to be generated by the project and the present value factor. So here what happened? Net cash flows before tax. So net cash flow before tax means depreciation has not been deducted. So you have to find out the depreciation and subtract. Thereafter, you have to find out the tax and add the depreciation back. That step you have to carry over. So the value what we have been given here is nothing but cash inflow before tax. You are required to calculate the payback period and NPV. For all these things, I need to find out the cash inflow. In simple sense, cash inflow is nothing but cash inflow after tax. Is that okay? For project 2, the cash inflows are totally different year on year. So we have to calculate separately for that. But in case of project 1, the value remains constant, so it's very easy. For project 1, cash inflow before tax 4,000 year on year from year to year 5 minus depreciation. Original value is 10,000 rupees, life being 5, so the amount of depreciation being 2,000. 6,000 being earnings before tax. From there I have to subtract the tax in this case being 50%, 3,000. Okay, depreciation should be subtracted, no? So it is 2,000 rupees, sorry. EBT is 2,000. Tax 50% 1,000. Then you will get EAT. EAT in this case being 1,000. You have to add the depreciation back to find out the cash inflow for project 1. Similarly for project 2, then in this case cash inflow before tax. For project 2, cash inflow before tax for the 5 years, year 1, year 2, year 3, year 4, year 5. No other way you have to calculate independently. First year 6,000, second year 3,000, third year 2,000, fourth and fifth year 5,000 each. Subtract the depreciation. Depreciation also be the same 2,000 rupees year after year because original value is 10,000. After subtracting the depreciation, your earnings before tax or profit before tax being 4,000, 1,000, 0, 3,000 and 3,000. You have to subtract the taxation here. The tax in this case being 50%. So 2,500 dash 1,500, 1,500. Earnings after tax in this case being 2,500 dash 1,500, 1,500. You have to add the depreciation back with this. The depreciation remains 2,000 in all the 5 years. Okay, all the 5 years. Now you have to find out cash inflow. First year 4,000, second year 2,500, third year 2,000 and 3,500, 3,500 each. So you are required to calculate payback period. Under the first one, cash outflow divided by cash inflow for project 1. Cash outflow in this case being 10,000, inflow being 3,000, 3.33 years. In case of project 2, you have to find out the cumulative cash inflow. First year 4,000, second year 6,500. First year 4,000, second year's cash flow 2,500 is added to arrive cumulative cash inflow for the second year 6,500, then 8,500, 12,000 rupees, and then 15,500. My required investment being 10,000, we received that anywhere between third and fourth year. Okay, for project 2, payback period. So third year we almost closer to our required investment, but that's a shortage. The shortage by the end of third year for my required investment being 1,500 in the numerator. The amount of cash inflow in the next year being 3,500. For the whole year I get 3,500, but my requirement is only 1,500. Out of 3,500 to earn 1,500, how many months we are in need? You can multiply with the 12 or simply write in decimal. If I write that in decimal, I will be getting 3.43 years like. Okay, right, round up this. 3.43 years. So as per the payback period, the lowest payback period is most suitable. So we have to choose second one. Okay, project one is chosen because it has 3.33. Second one is 3.43. Apart from that, you have to calculate NPV as well as PI both for this illustration. So we have completed the payback period. So now we'll just go for calculating the NPV. Okay. So here payback period being project 1 and project 2. Payback period 3.33, 3.43. And project 2 is chosen. Sorry, project 1 is chosen. Now for NPV calculation, 3.79, cash outflow being 10,000. So the NPV being 1,372. Okay, this value is 11,372. Okay, PA is nothing but this one is in the numerator. Cash inflow into anti-factor. Discounted present value means discounted cash inflow will be the numerator value divided by cash outflow. So 3,000 into 3.79 divided by 10,000. Then the value being 1.14. So NPV for project 1, 1,372. PA for project 1, 1.14. We'll now calculate the NPV and PA for the project 2. So for project 2, year 1, 2, 3, 4 and 5 years. Cash inflow for all this year. We already found out this one here. Very first year 4,000. Second year there is a slight drop to 2,500. Then drop to 2,000. There is a significant increase in the subsequent 2 years, 4 and 5, 3,500, 3,500. As the cash inflow is not uniform, you have to discount using single P factor, 10% P factor. I'll use 3 digits here. 0.909 is the P factor for first year at the rate of 10%. Second year 0.826. Third year 0.751, fourth year 0.683, fifth year 0.621. If you multiply these two, then you will get discounted cash inflow. Discounted cash inflow in this case being 36 in the very first year, next year 2066, third year 1503, then 2391. The last year 2173. Overall value being 11,769. This is what about summation of discounted cash inflow. From there, cash outflow at the 0th period is going to be subtracted, which is 10,000 rupees. So after that, the ultimate value what you get is the NPV. So NPV being 1,769. The project gives you more NPV will be chosen. So naturally, we have to choose second project, not the first one. Second project, not the first one. Now we can calculate the PA also. As per the PA calculation, summation of discounted cash inflow should be the numerator divided by cash outflow. So numerator value being 11,769 and denominator value being cash outflow, which is 10,000. The ultimate value being 1.18. So as per the PA selection criteria, higher PA will be most suitable. So second project gives you more PA. So we have to choose PA only, means second project only. Is that clear? So in mutually exclusive projects, first illustration we have seen based on the expenses calculation. Second illustration, in one project we have been given uniform cash flows. In this illustration, I have particularly added this illustration because here the term is cash inflow before tax. You may tempt to answer that it may be cash inflow. No, cash inflow after tax is different, cash inflow before tax different. Here cash inflow before tax. From the cash inflow before tax, you have to arrive the cash inflow after tax, and then you can proceed. One illustration is all about uniform cash flows. Second one is ununiform cash flows. So we have completed both. Clear? Yes, make a note of it. Question number 12, life in different years. Also mutually exclusive projects, but life is in different years. Company X is forced to choose between two machines, A and B. The two machines are designed differently but have identical capacity, do the same job. Machine A cost us 1,50,000, okay, at the 0th period. Machine A cost us 1,50,000 and will last for 3 years, life being 3 years. It cost us 40,000 per year to run. Cash outflow from year 1 to the life end, 40,000 rupees. So we don't have inflow here. We don't have inflow here. Machine B is economy model costing only 1 lakh. In case of machine B, the cash outflow for purchasing this amounts to rupees 1 lakh, but last only for 2 years, the life being only 2 years. And cost us 60,000 rupees per year to run. Okay, from 1 to 2 years, only 2 years. Thereafter, we have to go for replacing new one. These are real cash flows, real cash flows. Already, the cash flows is arrived by adjusting the depreciation and all. So you don't need to further worry about depreciation and all. The costs are forecasted in rupee of constant purchasing power. Ignore taxation. So we never bother about the taxation. The rupee also based on the constant purchasing power. So it means you have to adjust for the rate of interest only. See, today's 100 rupees and tomorrow's 100 rupees. This may be in 2025. This may be in 2026. Naturally, these two are not same, right? Because interest. Today's 100 rupees will be tomorrow's 110 rupees if there is rate of interest applicable. If you could have deposited 100 rupees in the bank, you will get around 10 rupees. Okay. So today's 100 rupees should be equal to tomorrow's 110 naturally. Is that clear? But not only that, we have to consider one more part, which is nothing but inflation rate. Okay. Today, with your 100 rupees, you can purchase tea price being 10 per tea. So how many tea can be purchased? 10 tea can be purchased. Matter of 1 year later, the 100 rupees you could have deposited in the bank, it becomes 110. By the time the cost of tea is increased to 10 rupees 50 paise, then how many teas can be purchased now with the amount you have in our bank account? 110 divided by 10.5. Come on, tell me. Huh? 10 point? Tell me. 10.47. You have to tell me, no. Now, why do you eat that? So what? The point is the fraction is also matters here. So from this it is very clear. Interest has impact to the extent of 10%. Inflation has 5% impact. Together with, ultimately you have only net benefit of 0.47, otherwise 4.7% gain. 4.7. Interest gives you more revenue, but because of the inflation, your purchasing power has gone down. You may say, 100 rupees instead of keeping in my pocket, I could deposit in the bank. So this becomes 110. You think because of 110, you can purchase higher. You think 1 lakh rupees. You inquire about the car. The car cost us rupees 1,20,000. Okay, you thought purchasing this car is really costly for you. Okay, you have this much in your savings. Car price is 1,20,000. 1 year later, you get almost 20% growth. 1 year or 2 years, your money becomes 1,20,000. Now you are very happy to purchase the car. When you go for purchasing the car price is 2 lakhs. Now what is the benefit at all? So you have to compare these two. Not only interest rate, inflation rate should also be parallelly studied. Thank God, not available at inter level, it's available at final level. Okay, so you have to incorporate these two at final level, not at your inter level. So you understand today's 100 is not equal to 100 rupees later because of the two reasons. One is interest, another is inflation. At the preliminary level, inter level, we never bother about the inflation rates. To make you understand that concept, this term is used. Constant purchasing power. Constant purchasing power means today also you can purchase a tea for 10 and tomorrow also you can purchase at rupees 10. Okay. Today also you can purchase the car for 120. Tomorrow also you can purchase at 120. It means I is equal to inflation is equal to 0. That's how you can assume. But of course, we never bother about adjusting the inflation in our study at your inter level. So finally, you can incorporate that one also, not now. Clear? Hope now you'll be able to understand. An applicable cost of capital being 10%. Yes. Now tell me, discounted cash outflow. We don't have inflow, only cash outflow. First one is original investment. For investment, this much. This amount remains the same. Today's value, 1,50,000, 1 lakh. And expenses. This one. You have to multiply with the annuity factor. Now tell me the annuity factor at the rate of 10%. At the rate of 10%. Come on. For machine A, 3 years is there, so you have to find out the annuity factor for 3 years. What is the 3 years annuity factor here? 2.486. For B, 2 years, you have to find out 2 years annuity factor, 1.735. So if you purchase A, immediately you spend 1,50,000. Today's value itself 1,50,000. No need to bother about discounting that. To run the machine A, we need to spend 40,000 rupees by the year end for up to the life 3 years, 40,000 rupees. The present value of the 40,000 rupees being multiply the cash outflow with the annuity factor 2.486. If I multiply, then the value being 99,440. Similarly, for B, 1.735 is multiplied with 60,000 rupees. Then the value being 1,04,100. Now overall discounted cash outflow being in the very first case 2,49,440. In the second case 2,04,100. 2,04,100. Clear? Come on, tell me. Between these two, which is better one? A or B? Between these two, which is how? But that will work for only 2 years. B works for 3 years. How? You have to calculate logically. Now you have to find out what is the discounted cash outflow per year. Equated cash outflow per year, per annum. How can you calculate this per annum? 2,49,440 for 3 years. Then what is the cash outflow per year? You have to divide this by annuity factor. It is not by 3. It should not be by 3. It should be by annuity factor. So 2,49,440 divided by annuity factor 2.486. What is the value you are getting? 1 lakh 338. For the next one, 2,04,100 divided by 1.735. This value being 1,17,637. Now you can choose based on the lowest amount you spend. This one will be chosen. This is not chosen. So you have to find out the net present value as usual. Thereafter, as the lives are different, you have to find out the cash outflow, equivalent cash outflow per year. For that, net present value should be divided by annuity factor. See, logically you can do this way. For project A, year 1, year 2, year 3, you get 1,338, 1,338, 1,338 as cash outflow. You have to multiply with the PV factor. Okay. Then the value what you finally get, this is called this value. Logically. You have to discount now. Isn't it? PV factor at the rate of 10% being 0.909, 0.826, 0.751. Instead of multiplying these two to get the answer, you can simply multiply annuity factor to get this value, isn't it? So only we are converting the NPV into equivalent cash outflow per year by dividing by annuity factor, not fully by 3. 3 is different and annuity factor is different. Unless you receive that 1 lakh every year for 3 years, you don't get this much money. 2,49,440 is equivalent to 1,338 per year for 3 years. Okay, this means this way 0, 1, 2, 3. You are getting 1,338, 1,338, 1,338. And what about the present value? You have to multiply with this annuity factor. So in a reverse case, we have been given 2,49,440. You have to find out this value. Then you have to divide this by annuity factor to arrive this one. To arrive this one, what we do? We have to multiply with the annuity factor. Is that clear? When we have the equivalent cash inflow and to find out the summed value, you multiply with the annuity factor. If the summed value is given, to find out the equivalent value, you have to divide that by annuity factor. Reverse case. So if you are very free, don't have any work, idle and sitting, then you can solve this illustration the other way also. What is that other way, sir? Very interesting, right? Not required for the examination. A has life of 3, B has life of 2. Now there's a lots of confusion because life is mismatching. Now make the life equal. How? Take the LCM. The LCM of 3 and 2 may be 6. Now you can find out the cash flows for the 6 years. Cash flows for 6 years. Okay. Cash flows for 6 years. Of course, it is only for understanding purpose. 0, 1, 2, 3, 4, 5, 6. If you apt machine A, you spend 150 at 0th period. By the end of 3rd year, it will go off. Then you have to purchase one more asset here, 150. Apart from that, for this asset, you spend 40 every year for 3 years. By the 3rd year, the machine A has been worn out. I need 6 years operation. Go for purchasing one more A by investing 150. For that 150 every year, I am spending 40 rupees for the remaining 6 years. Then ultimate cash outflow being 150, 40, 40, 190, 40, 40, 40 outflow. In case of B, very first year I spent 100 rupees. Thereafter, I spent 60 by the first year end, second year end. Then it becomes waste. Then I had to purchase one more asset by the end of second year. For that, I spent 60 for 2 years. By the end of second year, the 4th year, again, it is wasted. Then we need to purchase one more new one for 100 rupees. For the third machine, again, I spend another 60. Another 60. Now, what about the cash outflow for the machine 1? Very first year 100, second year 60, third year 160, again 60, again 160, again 60, again 60. If you calculate the NPV for this one and this one, compare, then you will get the same answer. A may be chosen. Okay, which is the easiest one, this model or this model? So this one seems to be easiest one. This may be bit complicated. Sir, not complicated, sir, pretty easy, sir. Then take the different life being a 7 and 8. One machine has 7 years life, another machine has 8 years life. Then you have to take the LCM 56 years. So you have to calculate for 56 years and the exam bell may run. You have to come out. So you have to be double cautious. So shortcut may be this one. You find out the NPV as usual for the given year life. Thereafter, find out the equal NPV by dividing that NPV by annuity factor. Oh, okay, you now understand the logic behind. Come on, make note of it. So with that, mutual exclusive projects are over. C. Another type of practical problem. Fifth one, capital rationing. Capital rationing is nothing but where the amount available for investing is limited. We have the multiple projects. All the projects can be chosen, okay, based on available fund. The all project requires around 10 lakhs, but you have only 4 lakhs. Like so, now the problem is how can you wisely invest this 4 lakhs for available projects? Probably you have A, B, C, D, E, 5 projects. Out of 4 lakhs, you may choose B, C, or only A, D. Like few projects can be chosen. It is not falling under mutually exclusive. Mutually exclusive means once you choose one project, the other project could not be chosen. But here you can parallelly choose both A and B and C also. You want to choose all 4 or 5, okay, of course you can choose, but you don't have the cash. If the cash is shortage, how can we plan? That's all about capital rationing. So, capital rationing. A limited fund available for investment in viable projects. Second, projects are mutually exclusive or not mutually exclusive. Mutually exclusive means one, if you choose one, the other one cannot be chosen. Here it's not so, you can choose both. And projects are divisible and indivisible. The project could be divisible or indivisible. In your examination, maximum you may get the question like divisible or indivisible. Predominantly indivisible. Indivisible has some permutation combination to arrive at the solution. But in case of divisible, that seems to be easy. Divisible means a project A requires capital investment of rupees 10,000 and project B requires 5,000 rupees. If you have 12,000 rupees, what you can do? You can either choose A completely and B still you have 2,000 rupees fund available, you can invest 2,000 for B. This is called divisible project. In case of indivisible, okay, out of available fund, if you choose A, 10,000 has gone. Still you have 2,000 rupees. Can you choose B? If you want to choose B, you need to invest B fully 5,000 rupees. You don't have 5,000 rupees, so you cannot choose B. Right. For example, A may be Toyota car, B may be Honda car. You have 12,000 rupees, you purchase Toyota car. Still you have 5,000 rupees, go to the Honda car and ask only for the engine. Will it be possible? I need only body. So if you want to purchase, you have to purchase the full car. But it is divisible means to what extent you need, you can purchase shares. Sir, I have 5,000 rupees. Okay, you purchase 10 shares. Sir, I don't have 5,000, only 2,000. Okay, purchase only 2,000, 2 shares. Also possible. So divisible where the project could be divided into any denomination as per the fund requirement. But in case of indivisible, you have to either accept for the full payment or you cannot accept. So here you have the choice of choosing either A or out of 12,000 rupees, if you choose B, you spend already 5,000 rupees. Still you left with the 7,000 rupees to choose A. You need 12,000 rupees. You need 10,000 rupees, but you left with only 7,000 rupees. Definitely, you cannot choose A. Now the problem is, among these two, between these two, which is the better one? Do I want to choose A or B? Compare the NPV. If you choose A by investing 10,000 rupees, NPV may be 1,000. If you choose B investing 5,000, it may give the NPV 1,500 also. Who knows that? That's why I tell you, in case of indivisible project, we need to have a permutation combination. You can choose this one and that one out of available fund, and decision is based on the NPV you get from those investment. NPV from those investment. If I do this one, the NPV may be 1,000, and instead of that, if I go for B, I get NPV being 1,500. Out of available fund, of course, you can go for and go for. Both may be possible, either this one or that one. But result wise, this may be superior. So you have to go for various combination and find out of various combination how much of your fund is used. Though you used full fund or proportionate fund, no problem. How much is your NPV will be the final decision criteria here. The fourth one is allocation of fund for the maximum return. So you have to allocate your fund which gives you more return. So this is what about the capital rationing problem A and B, divisible projects and indivisible projects. Divisible projects and indivisible projects. Is that clear? Now let's move on to that. Question number 13. We start with indivisible projects. And 14th divisible project. If you assume that 14th being divisible or indivisible, in both the way you have to work out. Clear? Now, let's start with question number 13. Indivisible projects. Indivisible projects. Vedika Limited with a limited investment fund, rupees 6 lakhs. Limited investment fund, 6 lakhs. Is evaluating the desirability of 5 indivisible investment proposals. 5 proposals are there and all the proposals are indivisible. We cannot divide that. The profiles are summarized as below. So for all the 5 projects, we are in need of how much of investment? Come on. 7, 9, 10, 12 lakhs 40,000. Am I right? We are in need of 12 lakhs 40, but we have only 6 lakhs. It's now sure that we cannot choose all the 5 projects. Okay. Projects N and Q are mutually exclusive. Okay. N and Q are mutually exclusive. What does it mean? If you choose N, you cannot choose Q. If you choose Q, you cannot choose N. The cost of fund being 10%. Cost of fund being 10%. Find out the feasible combination of the projects and rank them based on the net present value. Now, first of all, you have to find out the NPV. You have to find out the NPV. How do you get the NPV? Cash inflow multiplied with the anti-factor minus cash outflow. This is being the cash outflow. This is being cash inflow. Life is given, so you have to find out the anti-factor here. 10% anti-factor. This one is 10 years. So you have to find out the anti-factor for 10 years. Come on, tell me. Anti-factor for 10 years. I think 6.145. 6.145. In case of N, 4 years. Find out the 4 years anti-factor at the rate of 10%, 3.170. O, 8 years. So 8 years anti-factor, 5.335. For P, 16 years. 16 years anti-factor, the rate of 10% being 7.824. In exams, these anti-factors may be given, no need to worry. For Q, 25 years. 25 years anti-factor, the rate of 10% being 9.077. In your non-scientific calculator, calculating anti-factor for 25 years may be very tough job. But what you can do is very simple. So in your calculator, how do you calculate the P factor? So anti-factor is nothing but 1 divided by 1.1. If you press equal, this is the P factor for the first year. You have to press again so that you will get the P factor of the second year. You have to press continuously until 25 times. You have to press equal and take the grand total button. Now, in your calculator, in the top, there is a small number representing how many operations you have typed. Okay. See, in the top, I think, if I divide 1 divided by 1.1, press equal, you have the operations in the left top corner, I think so, 0, 3 times. 1 equivalent is equal to 3 times. I need to press 25 equivalent. It means that number should be 27. That number should be 27. First equivalent is equal to third operation. Are you able to see that? Huh? See? Okay. In your calculator for CA, here, okay, so you get this number here, 150. What does it mean? 150th operation. 1 divided by 1.1 equal 3 operations carried over here. So the first equal is equal to third operation, second equivalent is equal to second operation. So you can keep this idea in your memory for 8 years or 10 years. For 8 years, 10 should be there. For 25 years, 27 should be there. That's how you can by heart. So usually you miss the calculations now and then, and it should not spoil your mark. So that's how you can understand easily. Here you just do the pressing operation for the equal. 27 should come there as a 27th operation. So then you can take the grand total button to get this answer right. Clear? Cross verify later on, not play now. Okay. Or you can adjust the numbers. Right. Come on now, tell me. NPV is nothing but you have to multiply the anti-factor and cash inflow. From there, cash outflow should be subtracted. So 36,000 into 6.145 minus 1 lakh. Get me the NPV here. So 1,21,220. Second one being 1,17,000. Third one being 80,100. Fourth one being 3,25,920. The last one being 1,44,620. Now, how to choose the combinations? Find out the feasible combination of the projects and rank them based on the NPV. Okay. Now, remember, this is the best logic to solve this illustration. How? Combination number 1. Combination number 1. I choose M. Start with the first one. M. Then N. Okay. M 1 lakh over. N 2 lakhs. Then I choose O. For that I am in need of 2.4 lakhs. Can I choose P? No. Because I have only 6 lakhs. How much I have been invested currently? 1 plus 2 plus 2.4? 5.4 over. So that's all we cannot invest. Then what about the NPV of this combination? You have to add the NPV of these 3 projects. So I have chosen only the 3 projects. Now the question is that optimum one? No, I have to go for trial and error method here. So you do lots of permutation combinations. So while doing the permutation combination, follow the procedure I tell you. That may be pretty simple. Start with the first, second, third like. So first is 1 lakh, second one is 2 lakhs, third one is 2.4 lakhs, overall 5.4 lakhs. Hereafter I don't have the fund. Now find out the NPV for the 3. 1,21,220 and 1,17,000 and 80,100. If you add up all the 3,18,320. 3,18,320. Good. I got the answer from Archana also. 320. Let's now move on to the next one. Let's move on to the next one. Last one you just leave. Last one leave. Go for the next one. M has been chosen. M has been chosen. I'm going to replace instead of O. Instead of O, I can go for P. Then what is the amount? 1 plus 2 plus 3, 6 lakhs completed. I don't have any surplus. So 1 plus 2 plus 3. All my investment, all my available fund is used here. Now find out the NPV for this combination. 64,140. This combination is superior than the earlier combination, where all of our investment also made in amount available in our hand is used, and the NPV is also quite good here. We should not stop here. We have to go for all other options also. The next, third option. What I have to do? I have to change the last one. Third one. I have chosen M, N, Instead of P, can I go for Q? No. As I have chosen N, I cannot choose the Q because N and Q are mutually exclusive. If I choose N, I cannot choose Q. So only M and N is possible, but already we have M and N along with O and P. That may be superior, so you no need to worry about this combination. This combination is useless combination, not required. Let's go for the next combination where O and P is already changed. Now we can change the N. Rather than N, we can go for the other one. So fourth one. First will be M. And earlier cases we have chosen N. Now I want to replace N with some other one. So M. Then I can go for O. Here 1 lakh, here 2.4 lakhs. After O, we can go for P. What is the value for P? 3. No possibility. No possibility. So then I can go for Q. Is it possible? Definitely not possible. MO along with N is superior, so this option is not recommended. MO is over. Then what do you have to do? MP can be chosen. MP can be chosen. Okay, fifth one. M plus P. M requires 1 lakh and P requires 3 lakhs. That's all. I cannot choose other one. Okay. Q cannot be chosen because requires 4 lakhs, but we have only 2 lakhs. This option is also not advisable because MP along with that N is also we have already chosen. That option is better. So 3, 4, 5 logically not advisable options only. Then we'll go for the next one. Sixth option. We have to choose M and rather than P directly go for Q. Directly go for Q. This combination up to now we have not chosen. M requires 1 lakh and Q requires 4 lakhs. We have invested 5 lakhs. Still we have surplus 1 lakh. That surplus 1 lakh cannot be used anywhere. Now tell me what is the NPV for these two projects? 2,65,840. But this project seems to be, this combination seems to be least important. Okay, least profitable for that. So what happened? We have changed the second one. Now we have to change the first one. M is removed and instead of M we can start from N. Seventh combination. We now remove N, we can start with N and O. So what we can do? N and O. N and O, it requires 1 and it requires 2.4. 4.4 over and the return being very lesser. NO along with NO we have M also, so it is not required to be chosen. It's not in our choice. You no need to show that option also in your exams. You need to show option 1, 2 and 6. 7 is not required. Then 8th option N rather than O, you can jump to the next one, P. So NP, do we have NP? Yes, already we have NP along with M. So definitely this option is not better, so you can reject this. After that N and Q can be chosen. N and Q. Do we have N and Q? No, currently we don't have N and Q, so we have to definitely incorporate this one. N requires 2 lakhs, Q, but if you choose N, Q cannot be chosen, so this option will not definitely come. M method, M based calculations over, N based calculations also over. Then now we can go with the O based calculations. So now 9th one. If I choose O, 2.4 lakhs has gone and 3 lakhs is still we have for P. So I can invest in P. O and P I need 5.4. Naturally we can invest. And do we have O and P earlier? No. So definitely this will also be one more recommended model. In this case 2.2 plus 2.4 is invested and my NPV for these two projects. Come on, tell me. Sorry, 2.4 and 3. 2.4 and 3. Okay. 2.4 and 3 invested. So what is the final value? 4,06,020. Anyhow, second combination seems to be superior. Then we can go with the O and Q. O and Q not possible. So leave it. Then 10th option could be P and Q. No, we can either choose only P. Or 11th option we can choose only Q. But These two options not required. But choosing only one is not advisable. You can choose one or two also extra. Already we have completed all these calculations. Now possible combination you can address here being number 1, number 2, number 6, number 9. Among these combination, number 2 is the superior one. So we can choose second combination and recommend where we can use entire of our available fund and we can get NPV the maximum 5,64,140 NPV you can achieve for your entire investment. Is that clear? This is called capital rationing problem in divisible projects. Okay. Trial and error method. Trial and error method. You have to do some combinations. What I have explained here. Okay. Come on. Make a note of it. These combinations not required to show in your exams. But you can do as a working note. This is not possible. This is not possible. Like you can give the working note and highlight these combinations only. Among them, you can choose the second combination. In Singar Academy text, I have given how many combinations? 4 combinations only, right? 4 combinations. Then you can give the rank. First rank, this one. Second rank, this one. Third rank, this one. Fourth one, this one. Clear? Question number 14. Divisible projects. Okay. Though the problem being divisible, we can calculate these this particular problem assuming the projects are divisible as well as indivisible. Both the model we can solve. Okay, estimator has 10 lakhs allocated for capital budgeting purposes. The following proposals and associated profitability indexes have been determined. So we have been given the PA also. Which of the above investments should be undertaken? Assume that the projects are indivisible and there is no alternative use of money, or divisible. These are the 2 assumptions we have. These are the 2 assumptions. Now, before we proceed further, I am in need of what? NPV. Let me first solve assuming the projects are divisible. Thereafter, I will just solve using indivisible logic. So, in case of indivisible logic, we have to do permutation combinations. Like, so you have to club some projects to find out whether the amount is fully utilized and the NPV is also higher. How can you calculate the NPV if the profitability index is given? Very simple. You have to multiply profitability index minus 1. With that, this cash outflow. That's all. This is what about the NPV. Isn't it? 1.22 means that 1 is equivalent to the capital investment. 0.22 is nothing but NPV. That's how we calculated, right? So automatically 0.22 will be your NPV share on your investment. 3 lakhs into 0.22, your value being, so you can calculate the NPV this way. So cash outflow multiplied by PI minus 1. 0.22 into 3 lakhs, 66,000. Here 0.05. If it is less than 1, then it's definitely loss. 7,500 loss. From this, it is very clear we should reject the project number 2. Should not choose. As it gives you loss, why do I want to choose this? And third one is 0.2 into 3.5 lakhs, 70,000 rupees. And fourth one, 0.18 into 4 lakhs 50. 81,000. Here 0.2 into 2 lakhs, 40,000. The last one being 0.05 into 4 lakhs, 20,000. We got this. And a divisible project, you know, you can simply rank based on the PA. PA rank. PA rank. Project 1 gets first rank, 3 gets second rank, and 5 also second rank. Okay. Then fourth gets fourth rank or third rank. Ranking. tie is there. No, I can number it 2, 2 and this may be 4. Sometimes it may be 2, 2 and this may be 3. That's also you can ranking. You can give the ranking and this will be 5th rank and this will be the last rank. So the best method of choosing being, you have to choose the project. 1, cash outflow for project 1 being 3 lakhs and NPV of your project being 66,000. Okay. Second project being rank 2, 3 can be chosen. 3.5 lakhs is the investment. 70,000 rupees being your NPV. You need 10 lakhs rupees to be spent. Already 6.5 lakhs spent. Again, you can go for the 5th one. For that, you are in need of 2 lakhs. Your NPV being 40,000 rupees. This is chosen based on PA ranking. PA ranking. The next one being 4th rank. 4th project can be chosen. We have spent 8.5 lakhs. Still, we left with only 1.5 lakhs. Can I invest that 1.5 lakhs in project 4? Yeah, of course. Project 4 though requires 4.5 lakhs. The project being divisible to the extent of how money I have, I can invest. So I have only 1.5 lakhs. I can invest it. For 4.5 lakhs, I'm getting 81,000. For 4.5 lakhs, I'm getting 81,000. As I've invested only 1/3, what could be my return? Only 1/3 of that 81,000, probably 27,000. This is 27,000. Now, overall, my investment being 10 lakhs. And my NPV for this selection or combination chosen being 2 lakhs 3,000. Come on, tell me which is the easy one for you? Divisible projects or indivisible projects? Divisible or indivisible? Naturally, then what you can expect in your exam? Indivisible only. Huh? As even a layman can understand and do this easily, then how can you expect in your examination? Most probably in your examination, the projects are indivisible. Can I rework out this, assuming this project being indivisible? Clear? Right. Shall I move on to the next one? Come on. If it is clear, text me so that I will assume this being indivisible and rework out. Yeah. So we got the NPV. So we have to take lots of combination. Combination 1 being, I have to start from 1. Project 1, project 2, 3 plus 1.5 lakhs, 4.5 lakhs. Project 3, 4.5 lakhs plus 3.5 lakhs, 8 lakhs. I cannot choose 4 because it requires more fund, but I can choose 5. I can choose 5. So first combination being 1, 2, 3, 5. From the top order, you go adding one after one. So 3 lakhs, 1.5 lakhs, 4.5 lakhs plus 3.5 lakhs, 8 lakhs. 4th, I cannot choose because it requires 4.5 lakhs. I have only 2 lakhs because I am going to consider this being indivisible projects. Indivisible project. And as I have chosen these 4 projects and I have to find out the NPV. But anyhow, second project is always loss making. You can rule out that completely. You can rule out this completely. So I can erase this. So 1 third project. So 6.5 lakhs chose already spent. 4th one 4.5 lakhs, but I don't have the money, so I have to choose only 5th one. So overall cash outflow in this option being how much? Come on. 3 plus 2, 8.5 lakhs I spent. What about the NPV for this chosen combination? 2 lakhs? Huh? Definitely this combination will not have so much gain. Less than that. Come on, tell me. Always remember, under divisible project only, it will be possible to get more NPV. Here it should not be. How? 1,76,000. I am pretty sure in that, right? 1,76,000. 76,000. Is that clear? You understand the logic? Can I go for the second project? I have to change the last one only, which is not possible. 1, 3 chosen and last 5 we try to change, which is not possible. Instead of 5, if we want to go for 6, then we need 4 lakhs, 2 lakhs extra. Definitely we don't have the cash. Then leave the 5. Leave the 5. Leave the 3 also. Choose 1. Rather than 3, directly jump to 4th one. So 3 plus 4.5 lakhs, 7.5 lakhs. Yes, of course, you can choose 5 also. 3 plus 4.5 lakhs, 7.5 lakhs plus 2.5 lakhs, 9.5 lakhs. Come on, tell me the NPV for this project. 1,87,000. This seems to be better than the earlier combination. We'll now move on to the third combination. Try to change the last one. 146. 146 not possible. 146 not possible. Then remove the 4 also. Directly go for 156. 1, 5, 3 plus 2, 5 and 6 is 4 lakhs. Possible. I am in need of 9 lakhs. What is the NPV for these 3 projects? 1,26,000. You understand this? I start from the first, second, third like, and I'm just replacing the last one itself. If the last one replaced, then earlier to that one I'm replacing. Similarly, I'm doing all the calculations. Fourth one. So 5, 6 were already replaced. Now I have to replace 1. 2 not required. Start with the 3. 3, 4. 3.5 plus 4.5 lakhs, 8 lakhs. And of course, naturally, you can choose 5. If you choose 3, 4, 5, entire amount available with you is spent. Now find out the NPV for these 3. Hope it is 1,91,000. This seems to be a superior one among the other combination where all of your investment is made and your NPV is also higher. Anyhow, go for the other combination also. You have to finalize which among the other possibilities this seems to be better. So fifth possibilities. In among the 3, 4, 5, leave the 5, try to choose 6, which is not possible. Which is not possible. If I choose 3, 4, 6, not possible. So then I can choose 3, 5, 6. Is it possible? Yeah, of course. 3, 5, 6 possible. So fifth combination being 3 plus 5 plus 6. 3, 5, 6, 8.5 plus, sorry, 3.5 plus 9.5 lakhs. So we spend around 9.5 lakhs. What is the NPV of this combination? 1,30,000. 1,30,000. Then we'll move on to the other model possibilities. 3, 5, 6. 3, 5, 6. Now 3, 5, 6. Already 5, 6 over. So you have to now leave 3. You have to choose 4 and 6. 5 is okay. 4 and 5 are already chosen. So 4 and 6 can be chosen. 4 and 6 together we don't have anywhere. So 4 and 6 we have the option. For 4 and 6 we are in need of 8.5 lakhs to be invested. Left with 1.5 lakhs. We don't have any other options. Now come on, tell me this value. 1,01,000. Okay. Among all the models, this seems to be superior. The fourth combination seems to be superior where our NPV is also higher. All of our fund available also be invested properly. Clear? So now you'll be able to understand this one. Capital rationing problem. Almost all the models are over. Only one left to our model being replacement model. Very rare. Actually, that was earlier in final only. Now, few illustrations are there in text at the inter level, but very rare in your examination. Rarely, sometimes. You just understand that one also. So, we have completed all the concepts at the inter level. So, we have to complete the replacement and small variations also. Once it is over, then entire capital budgeting will be over. Clear?